So during our last class, I was explaining the concept of valuation. I introduced you to valuation, and I said that valuation is the process of determining the economic worth of a business or of a company's share. Then we talked briefly about the purpose or reasons for valuation, which include for merger and acquisition. We carry out valuation for estate and tax purposes. We said that we also carry out valuation for litigation in case there's a dispute between two parties. It could be between a company and a contractor or between the principal and the agent. So dispute can arise. So when that happens, there may be a litigation. When there's litigation, the courts may want to know the value of the asset in dispute to be able to determine how much claim that will go to either of the parties. All right. We also talk about the fact that when there is stock exchange listing, when a company wants to go for IPO, for example, initial public offer, you need to determine the value of the business. It's one of the requirements, all right? So we talk about the fact that if a company wants to access loan, all right, a company wants to borrow loan, depending on the size of the loan, there may be need for the company to be able to present to the lender, to present uh, the financial analysis, which will indicate his financial worth for the period. All right. Not only that, we also carry out valuation when there is shareholder or partnership disputes. All right. When owners of a business will not resolve disputes among or between them, or when partners in a partnership business have a dispute or misunderstanding and they could not resolve it. So the best would be that each party should go their separate ways. To do that, then you need to determine the worth of the business so that we know how much will be accrued to each or that will be attributable to each partner in the business. All right. So these are some of the reasons for carrying out a valuation of a business. All right. Then we don't talk about the methods of valuation. Technically, we said there are three core methods of valuation. We have asset-based approach. We talk about income-based approach, and then we were discussing cash flow-based before our time expired last time. All right. And then under the asset-based approach, we said valuation should be done by determining the net assets of the business, the value of a business using asset-based approach, value of a business represents the net assets. And if you are asked to determine value per share, then it has to be net asset divided by number of ordinary shares. Okay. And we said that there are 4 different categories of asset-based approach. We talk about book value, realizable value, replacement value, and then liquidation or breakup values. All right. Then after that, we talk about income-based approach. Under the income-based approach, we dissected price earning ratio method. We talk about dividend yield. Then we talk about earnings yield. We said the price earning ratio is valuation, whereby is the using valuation using price earning ratio represent the ratio of represent the price earning ratio multiplied by the earnings. Okay, so that will give you the value of the business. However, for you to be able to use price earning ratio to value a business, the business must be a profitable one. It must be a company that has a profitable history, which means that any company that is any loss-making organization, a company that does not have profit, all right, or that is not consistent in making profit, such company cannot use price earning ratio as a method of valuation. All right. And also, we said that price earning ratio can be used by any organization. All right. Depending whether it is a listed company or unlisted company. So the only difference between a listed and unlisted company is that as an unlisted company, any company that is not quoted on stock exchange, will not have price earning ratio, because price earning ratio is meant for listed public companies. All right. So, and then if you now want to value an unquoted company using the price earning ratio, then you must you have to borrow the price earning ratio of a comparable listed company. And in doing this, you must adjust for the risk inherent in an unquoted company when you value an unquoted company. This is because an unquoted company is more risky relative to a listed company. And that's why it is important that whenever you want to value a limited liability company using the price earning ratio, you have to adjust for the risk inherent. You have to adjust the price earning ratio downwardly between the ratio of 10 and 50. The percentage of adjustment will depend on the perceived risk associated with an unquoted company. All right. And in this circumstance, every student will not have the same answer, all right? Because I mean, decide to use 20%. I mean, decide to reduce the price earning ratio by 20%, which means I need to account for 80%. Another student can use 15%, other student can use 12%. Whatever you think is the perceived risk associated with an unquoted company is the percentage you are going to adjust for, except if examiner is specific. In fact, in some previous diets, at times ICANN will not adjust for the PE ratio. They will just use the PE ratio of a quoted company for an unquoted company without adjusting for that risk. At times they will adjust for the risk, but what is important is just have to do the right thing, because it is not appropriate to just use the price earning ratio of a quoted company for an unquoted company without adjusting for that risk. Because if you use the price earning ratio of a quoted company for an unquoted company, that means you are saying that both of them they have the same risk, which is not true. All right, that's not the case. So that is for price earning ratio. Then we talk about the dividend yield basis. We said that using dividend yield basis, the value of a business is the ratio of dividend to dividend yield, or cost of equity, of rate of return on equity. All right. Then depending on whether there is growth or dividend will remain constant to perpetuity. Whatever the case, I gave you the two different formulas that you can use to do that. Then we talk about the earnings yield basis. Earnings yield is similar to dividend yield, except that we are using earnings instead of dividend. And the valuation of a business using earnings yield basis represents the market value of future cash flows. The future cash flow is the earnings, then discounted at the rate of return of the company, or return on investment. Okay. So depending on whether whether growth, the earnings will grow or earnings will remain constant, the value of a business is the ratio of earnings to earnings yield. Okay, so that is what we discussed last time. Then we now talk about discounted cash flow method of valuation. And we said that the discounted cash flow method is the most sophisticated method of valuation, but because it's a method that relies heavily on the use of free cash flow for the valuation of a business. And we said that free cash flow is the cash flow that is available for distribution to providers of capital, including the shareholders as well as the debt holders. So the cash flow that is available for distribution after taking into consideration all expenses, all operating expenses and capital expenditure, whatever you have as a balance thereafter is what is known as the free cash flow. That cash flow is available for distribution to the providers of capital. Out of the free cash flow, you can use the free cash flow for expansion and growth. If a company has expansion activity to be carried out, you can use the free cash flow to kickstart it. Again, you can also use the free cash flow to pay dividend to ordinary shareholders. You can use the free cash flow to pay debt, okay, to pay part of the debt you are owing or the entire debt. Okay, so you can also use free cash flow for merger and acquisition. That is, to value a company. You can use free cash flow to value a company. So there are some of certain things that you can use the free cash flow to do. However, the reason why we are using free cash flow to value a business, and we said is the most sophisticated, is because of the fact that we don't use accounting profit. Accounting profit can be distorted because companies carried out so different kinds of accounting shenanigans or creative accounting for the purpose of managing their earnings, so that in order to achieve a specific target, depending on the targets that the company may want to achieve, they can those accounting profits can be distorted. For example, companies use different depreciation policy so to achieve a certain goal. All right. So this year they can adopt a particular policy. The next time they can change it to something else, just for them to be able to deceive the public. All right. But that notwithstanding, and that's why investors rely heavily on the use of discounted cash flow method for the purpose of valuation. However, not all companies can use cash flows for the purpose of valuation. Not all companies can use cash flow because cash flows, the use of cash flow is embedded with different kinds of assumptions. All right. So different kinds of assumption will be carried out when valuing a business using a free cash flow. The reason being that, for example, your cash flow must be consistent with the risk, okay, with the prevailing risk in the business environment. Say, for example, you have to factor in the country risk. Country risk are those risks that are available in a country that may impact the operation of investor, but the operation of business within the country. For example, you can have political risk arising from the political instability. You can have regulatory risk. It's part of a country risk. Regulatory risk, which could arise from the policies from uncertain, changing policies every now and then. So when you have an unstable economic environment, that can erode investors' confidence. You can have market risk. You can have economic risk like inflation. All right. You can have currency risk. All these things, put all those risks together. The totality of those risks is what is known as a country risk. And when you are developing your cash flow, you have to factor in the impact of inflation. How is currency, the fluctuation or the gyration in exchange rate, how is it going to impact the cash flow? So all of these things you have to factor into your cash flow when you are developing it. Not only that, there are different other assumptions that professionals or researchers or analysts that they have to incorporate when developing the cash flow. So, like for example, not only in Nigeria, across the world, banks don't use most banks they use a dividend discounted dividend model to carry out the evaluation. That is, they use dividend yield because this information is dividend yield model is faster and is readily available because almost all the banks all the banks pay dividend. So and then if it's a quoted company, for example, if a quoted bank, if the shares of the bank are traded on the stock exchange, you can easily see those information there. You know the share price. You know the share price of the company. You can see the other information that you are looking for the purpose of carry out your analysis or your valuation, so that at the end of the day you just make little assumptions, so that that's how it works generally in practice. You can also use enterprise multiples. You don't rely on only one method of valuation. I mentioned this to you last time when I was talking about the asset-based approach. The asset-based approach is just a minimum, is to provide a minimum guide for the value of the business. You have to use that in conjunction with other method of valuation. So we stopped last time. We stopped at free cash flow. And I told you that there are two types of free cash flow. We have two free cash flow to the firm. We also have free cash flow to equity. The free cash flow to the firm is the cash flow available for distribution to providers of capital, that is to debt holders and also to equity holders. The free cash flow to the firm is used for valuing the corporate value, is used for determining corporate value or enterprise value. You can call it corporate value or enterprise value. Then we talk about the free cash flow to equity. We said that free cash flow to equity is the cash flow available for distribution to equity holders or shareholders, and it is used for determining equity value. When you want to determine equity value, you use free cash flow to equity, apple for apple, all right? Because the corporate value that you want to determine, the enterprise value you want to determine is meant for two people, the debt holders as well as the equity holders. So when you have computed your corporate value, which is your total value in this case, then you need to split it into two. The proportion that relates to the debt holders, which is the debt value, then the proportion that relates to the shareholders, which is the equity value. All right, so that's what make up the corporate value. And I think we stop at free cash flow to the firm last week, and I gave you two formats. We wanted to talk about the free cash flow to equity before our time expired last time. I think we did. Okay, let me just give you one more format under free cash flow to equity. They will now begin to explain the scenarios involved. Okay, let me just use this. Let me see if I can use this one to explain. Let me see, is there anything missing here? I want to give additional one. Okay, let me switch. Let me switch to let me switch to the working notes so that I can use that one to explain in details. All right. So we want to let me briefly show you how to compute free cash flow to equity. All right. Free cash flow to equity. Okay. So like I said, the free cash flow to equity represents the cash flow available for distribution to equity holders or shareholders. It is used, free cash flow to equity is used for valuing equity or for determining equity value. All right. Now, examiner can ask you to determine equity value. For you to be able to do this, you need to first of all determine free cash flow to equity. After you have computed free cash flow to equity, then you need to discount it with the cost of equity. All right, so that you'll be able to get apple for apple. That way, whatever you have thereafter will then be the value, equity value. Now, to now determine the free cash flow to equity, there are three different formats that you can use depending on the information available in the question. If in the question you have been asked to calculate free cash flow to the firm, so examiner has given you free cash flow to the firm, and you now want to determine free cash flow to equity, then in this case, the first method, this first format will be whereby you are given free cash flow to the firm, or you have been asked to calculate free cash flow to the firm. In this case, our figures, let's say our figures are in million. So we are starting from free cash flow to the firm. So this figure may be given to you, or you may be the one that will calculate it. Examiner can say in the A part, calculate free cash flow to the firm. B, calculate free cash flow to equity. C, calculate the market value of equity of company XYZ, whatever. All right. So you use this formula that I want to give to you if you have already calculated free cash flow to the firm. Now, remember, I said that free cash flow to the firm will be distributed between the debt holders and then the equity holders. You have to settle. you have to share with the debt holders before the equity holders. So immediately after the free cash flow to the firm, you consider net interest. Anything that has to do with the debt holders must be considered before the balance will then go to the residue, will then go to the owners of the business. So immediately after free cash flow to the firm, you consider interest. In this case, it will be net interest. Okay, interest expense. So this interest will be net. So here will be interest. This interest will surely be given to you. Multiply by 1 minus tax rate. Okay, whatever it is, you less. Then after interest, you consider it is possible there may be loan repayments. Maybe the company has borrowed loan from the debt holders. The company has borrowed loan, then the company wants to pay back part of the loan. So you need to indicate, you need to return that loan repayments. It's a cash outflow. Money is going out. It is also possible that the company might have uh, borrow another entity a loan, and the entity, that company, is now paying back. Then that's what we call loan proceed from debt issued. We have proceed from debt issued. All right. So it's a plus. That's a cash inflow. All right. Now, before we arrive at free cash flow to the firm, we have adjusted for depreciation, we have considered changes in working capital, we have considered capital expenditure. All right. So, and that's why you don't need to bring those items here again. So this is what you are going to do. This, whatever you have thereafter, will then give you free cash flow to equity. This will give you free cash flow to equity. So this is the format whenever you want to calculate free cash flow to equity, starting from free cash flow to the firm. The second format is whereby examiner can ask you to calculate free cash flow to equity if in the question you are given profit before interest and tax. You are not given profit after tax. You are given profit before interest and tax. So in this case, you start almost from the beginning. All right. So I can say free cash flow to equity. This is starting from profit before interest and tax, or you call it earnings before interest and tax. So in the question, you are given earnings before interest and tax. So in this case, it will be profit before interest and tax, whatever it is, put it there. Remember, we are starting from profit before interest and tax. So in this case, you have to settle interest. I would then say interest expense. You less interest expense, then you have profits before tax. You then pay tax. Tax will be paid as profits before tax multiplied by company tax rates. So you less it. Your cash is going out. There's no need for you to find difference. So at this point, you had back non-cash item. So depreciation or amortization. Also, if you are given provisions, provision is not cash flow, but it has been deducted it has been embedded under operating expenses. So you have to add it back. All those non-cash items, you add it back. Then you have to consider changes in working capital. If your working capital increases, you less. If your working capital reduces, then you add. Then you consider capital expenditure. It is possible the company may need to purchase additional non-current assets. So that's your capital expenditure. It's a cash outflow. You put it in brackets. It is also possible that there will be loan repayments. There will be loan repayments. It's a cash outflow. You are paying loan. It is possible you may have proceeds from debt issues. From debt issued. So that's a plus. At the end of the day, you sum up whatever you have, represent your free cash flow to equity. All right. I don't know if you have done IAS 7, statement of cash flow. So it's not just about, because all this capital expenditure, especially if in the question examiner has given you statement of financial position for 2 periods, right? Say, for example, you may be given financial position for 2023 and the financial position for 2024. So when the examiner gives you such a scenario, it means that you have to consider changes in working capital and changes in non-current asset. It is possible that once you notice that between the 2 years, your working capital, there's a movement in your working capital, the inventory you have in 2023 is different from the inventory in 2024. That means there's a movement. So is it a plus or minus kind of movement? You need to consider that. Again, the non-current assets might have increased or decreased, whatever the case may be. You need to consider movement in your non-current asset as well. All right. There's a format, there's a formula that you can use for you to be able to do that. But what I'm saying in essence is that on the day of your exam, if you are given two different periods, statement of financial position, you need to watch out for changes in working capital as well as the purchase of additional non-current assets. And then the last format that you can use to calculate free cash flow to equity is where the examiner has given you profits after tax. Okay? Free cash flow to equity, where you are given profit after tax. Okay? What's wrong with you? If you are given profit after tax, then in that case, there's a slight difference from this and then profit before interest and tax. So, where you are given profit after tax, in fact, on the day of your exam, at times examiner can give you profit before interest and tax. You may also be given profit after tax in the same question. Always start from profit after tax. It is faster and shorter. All right. So you just pick the profit after tax. You post. Before they arrive at this profit after tax, they have paid tax, they have paid interest, they have considered, they have included non-cash item in the operating expenses. Therefore, all those items you need to make adjustment for them. So immediately after profit after tax, you need to consider non-cash item. Okay, you consider non-cash item like depreciation. All right, or amortization for leases, uh, amortization, then you have provisions. Okay, provision, you had it back. Then after this, you consider changes in working capital. So it could be decrease or increase. Let me write that. Okay, then you consider loan repayments. Before that, let's talk about capital expenditure. So cash outflow, then loan repayment, cash outflow, then proceed from debt issued, so plus. So this is your free cash flow to equity. So these are the three different formats that you can use to compute or to estimate free cash flow to equity. So you have to master them. You can see they are closely related, only few difference, but you never can tell on the day of your exam. You don't know which one examiner will give to you. All right. And that's why it is important for you to memorize them. Just master the format and you are good to go. All right. Now, this is how to estimate free cash flow. The next thing we want to talk about, when you are using discounted cash flow method for valuation, usually when there's business combination, there are three different scenarios that may arise. So we need to explain each of the scenarios and what you need to do under each scenario quickly, all right? Scenarios, valuation scenarios. I call it valuation scenarios. Okay. Basically, there are three different scenarios that may arise. Basically, there are three different scenarios that may arise when carrying out or during business combination that may arise during business combination. Okay. And this includes let's be fast so that I'll finish the scenario, then we solve illustrations. So scenario one, so under this scenario one, business risk and financial risk are expected to change. Okay, the business risk and financial risk will change. Okay, so let me put it down. This arises when business risk, when business and financial risk are expected to change as a result of business combination. Of business combination. When this happens, okay, when this happens, the free cash flow should be discounted using WACOB. WACOB simply means WACC of the weighted average cost of capital of the combined businesses. This is what I'm saying, right? It is possible that when there is a business combination, either through merger or acquisition, right? The two companies that are merging together or a company that is acquiring controlling interest in another entity, they may they may be in a different industry. Remember, business risk is the risk associated with the industry where a company operates, as measured by asset beta. Now, what we are saying is that when there is business combination, it is possible that the two combined businesses are not in the same industry. So when that happens, it means that business risks will change because they are in different industry. So there will be exposure. After the business combination, there will be exposure to business risk. The second one is the financial risk, which is the risk arising from debt financing. When a company finances its operation with debt, that means the company may be exposed to financial risk. Or it is possible that the debt equity proportion will change after the business combination. So when this happens, business risk is changing, financial risk will also change. In this case, you have to discount the free cash flow using WACC of the combined businesses. So the WACC of the combined businesses is similar to, is the same thing as WACC of the combined activities, WACOCA. The same 7 procedure you are going to carry out to calculate your WACOCA is the same thing you are going to do for your WACOB. The difference is just that instead of talking about activity, we are talking about businesses. All right, we are talking about businesses. Now, under this scenario 1, what are you supposed to do? What are the procedures, steps that you are going to, once you can identify from the question that business risk will change and financial risk will also change. Let me even help you further. And I want to solve question tonight, so I'm talking too much. Okay. Let's see. You can see I'm talking to myself. So business risk will change. Business risk will change. Let me write it out in full. Business risk will change if the combined businesses or companies, if the combined companies are operating in different industries. So if in the question there's an indication, you are told that the two of them are not in the same industry, it means that business risk will change. If examiner does not tell you that, if there's no indication in the question that they are in different industries, then if you are given asset beta for the two companies and the asset beta are different, once the asset beta are different, it means that they are in different industry. But if you are given the same asset beta for the two combined businesses, it means that they are in the same industry. So another indication to know whether business rate will change is if you are given different asset beta. Also, business risk will change. Business risk will change if a different asset beta, okay, if a different asset beta is given for each combined companies. Okay, so those are the two indications you are going to see on the day of your exam. Once you notice, one is that once you notice that you are told in the question that the two combined businesses, they are in different industry, it means that business will change. If the examiner does not tell you that, it is also possible that you may be given asset beta. Once the asset beta of the two businesses are different, you have company A, you also have company B, and the two of them, they have different asset beta. It means that business rate will change. That means they are not in the same industry. But if you are given the same asset beta for the two companies, it means they are in the same industry. That means business trade will not change. Yes, somebody is sending a chat. Let me check. Come again where? I said so many things. Speak up.
Yes, sir. Good evening, sir.
Yeah, good evening.
So you said when the two companies have the same asset beta.
Yes. What about it?
I did not get what you said that part.
I said if the two companies are given that have the same asset beta, that means they are in the same industry. So business trade will not change.
Okay, thank you.
Okay, so for the financial risk, I also told you that financial risk FR, financial risk will change if the two businesses, if if the combined businesses or combined companies, okay, or let me put it this way, financial risk will change if the business combination will result in additional loan or debt. You know, when you want to, there are different methods of financing business combination. All right. Part of the method of financing is through debt. So, because when you want to merge or you want to acquire another, when a company wants to merge with another company or a company wants to acquire a controlling interest in another company, you may not have the required or the requisite uh, finance to carry out the transaction. So there may be need to borrow loan. All right. So once you borrow because of that business transaction, then the combined businesses will be exposed, the combined company, the enlarged company in this case, will be exposed to financial risk. Once you borrow, once you are given information in the question that, okay, the company will need to pay debt for the purpose of the business transaction, it means that financial risk will change. So this is one way examiner will tell you. In addition to this, if you are told that after the business combination, the debt equity proportion, the gearing ratio will change. So once you are told that gearing ratio will change or will increase, it means that the financial risk will change. So in addition, um, in addition, if the debt equity proportion debt equity proportion uh, or ratio will change or increase as a result of the business combination. Combination, let me write it clearly. Then I said, in addition, if the debt equity proportion will change as a result of the business combination, then the financial risk will change. It means the financial risk will change. So these are the two different ways that you can identify from the question if financial risk will change. Examiner will not tell you financial risk will change, business risk will change. It is implied in the question based on the scenario. A few seconds, please. Let me. So it is implied the scenario will surely be painted for you. So you are left, you have to. The scenario will be painted for you to be able to deduce. You infer from the question what examiner is trying to communicate to you. Once you can see that the business combination arising from merger or through acquisition will result to additional loan being paid, that means financial risk will change. So, or if you are told that the debt equity ratio will change because of the business combination, it also means that financial risk will change. So when these two things happen, when business risk change, financial risk also change. Then in that case, you need to calculate your free cash flow to the firm. That's step one. Okay, let me just put it there. Steps to valuation. Under this scenario, under scenario one, what are the procedures? Step one, you calculate free cash flow to the firm. Calculate free cash flow to the firm. So using any of the formats I've explained to you earlier, I gave you two different formats. That was last time. Then step two, you calculate weighted average cost of capital of the combined businesses, WACOB. Weighted average cost of capital of combined businesses. Somebody may be asking me, what is WACOB? Let me write it out. Calculate weighted average cost of capital of combined businesses, WACOB. How do you determine weighted average cost of capital of the combined businesses? I want to give you a revision now on what we did under WACOCA. It's the same thing. So to do this, what are you supposed to do? To calculate WACOB, to estimate WACOB, what are you supposed to do? In WACOCA, you have 7 different methods, 7 different procedures. Step 1 is to identify the beta. Instead of identify the beta of a proxy proxy beta or the beta of each activity, you are not identifying activity here. So you need to identify the beta of each company, of each combined businesses. Company A, company B. What is the beta of company A? What's the beta of company B? So you identify it. Then step 2, you ungear the beta if it is geared. Ungear if geared. Remember, a gear beta is the one whereby the company has debt in its capital structure. If the two companies have debts, element of debt like bank loan, like a bond, debenture, or loan notes, if there's any element of debt in the capital structure of each company, it means that the beta you have identified in step 1 is geared. So if this beta is geared, you need to ungear it. You already know the formula to ungear. I gave you 2 different formulas to ungear, depending on whether debt is risk-free or whether debt beta is risk-free or debt beta is given. So you already know what to do. Then step 3 is to calculate pre-merger or pre-acquisition market value. Okay, we calculate let me call it pre-merger. Whether you call it pre-merger or pre-acquisition, depending on the nature of the transaction or of the business combination. So you calculate pre-merger market value. The same way you normally calculate market value, all those things that we did under our cost of capital is the same thing here. Just calculate market value of equity, market value of debt for each of the combined businesses. So then step 4, you calculate weighted average asset beta. Calculate, determine weighted average asset beta using the market value in step 3. Let me use all this one as a step. This is step 1, step 2, step 3, then step 4. All right. Determine the weighted average asset beta using the market value in step 3. Okay. As a weight. Or proportion. All right. Then step 5. Step 5. What do you do in step 5? You already know, let me put it out. You already know the weighted combined asset beta. We've done this under Wakuka. The combined beta asset of the combined will be calculated as beta asset of the first company multiplied by total market value of equity and debt of the first company over total market value of equity and debt of the first and the second company, then plus beta assets of the second company multiplied by total market value of equity and debt of the second company over total market value of equity and debt of the first and second company. All right, you are familiar with this formula. Then step 5. Step 5, you need to regear. You regear, okay, to incorporate the financial risk. To incorporate the financial risk of the combined businesses. This will be after the business combination. Then step 6, you already know the formula to regear in step 5, depending on whether debt beta is given or debt beta is assumed to be risk-free. Whatever the case, you know the formula. We've done it severally in the past. Then number 6, step 6, is to calculate cost of equity. Calculate cost of equity using capping. Capital asset pricing model. Again, you know the formula to use. We have done this severally. Finally, step 7, we calculate WACOB. Estimate WACOB. WAC, weighted average cost of capital of the combined businesses. That's all. These are the 7 procedures you are supposed to carry out anytime you want to estimate weighted average cost of capital of the combined businesses. Okay? So these are the procedures. Now, this is step 2. Then step 3. Step 3 now. Okay, step 3, calculate market value of the combined businesses. of the combined businesses for the initial period. For the initial period. Okay, the same way you normally calculate market value. Market value is the same thing as present value. So don't be confused. So when in this step 3, you are supposed to calculate present. Let me call it present value so that you don't get confused. Calculate present value of the combined businesses. All right. So what that means is that you are going to discount the free cash flow you have calculated in step 1. You are going to use workup to discount the free cash flow to get your present value. So you then add up everything together to get the present total market value. Okay, that is for initial period. Initial period is the period of the transaction. It could be for 3 years. Initial period could be for 5 years. It could be for 10 years. The examiner will show just like useful life of a project. So you are going to be told in the question, the initial period. You may have to determine market value for the next 5 years or for the next 4 years or 3 years or 2 years, whatever the period, examiner will surely give it to you. At all time, under valuation, apart from calculating in present value for initial period, you also need to calculate present value to infinity, meaning that present value after the initial period. Let's say, for example, the initial period is for 5 years. For the next 5 years, that's the initial period. After 5 years is year 6. So from year 6 to infinity, that is the period to infinity. So you need to calculate present value. Step 4 now. You calculate present value. Calculate present value to infinity after the initial period. After the initial period. Examiner will not tell you all of this, but it is implied in the question because when you are determining a value, when you want to determine the value of a company, the value that you want to determine is not just for a short period. What about the longer term, the future? So it is assumed that the company will continue to operate for the foreseeable future. The going concern of the business will not be curtailed. So the company will continue to operate to perpetuity. So you need to determine after the initial period, then you need to determine value to perpetuity, to infinity. So examiner will not tell you to calculate value to perpetuity, but examiner will surely, at times examiner can mention terminal value. Terminal value is the market value of the business after the initial period, that is market value to infinity. Okay, calculate the PV, calculate PV to infinity after the initial value, initial period. That is, let me put it in this way. That is, calculate terminal value. Terminal value. All right. So that's that. The terminal value is the market value to infinity of the business after the initial period. Then how do you calculate this? Depending, let me put it down for you. Depending on whether or not, cash flow, depending on whether or not cash flow will grow. Cash flow will grow at a steady rate. All right. So to do this, I will give you 2 different formulas. The first one, where cash flow will remain constant, where cash flow will remain constant, Ah, no, one hour. Ah, just now, we are spending 1 hour. Let me even see some of you that are online. Adeoshun, you are still there. Aisha, you are still on. Tony has joined. Augusta, you are on. Charity, Uju, Faith. Chinazo, Omawumi, you are welcome. You finally joined. Minister of Finance, Nkechi. Nkechi was not around when I was greeting all of you. Was consulting, Olamide later joined. He wasn't around when I was greeting when we started. Tayo was also not around when I was greeting all of you. Ufoma, yeah? Okay, no worries. Let's move on. My plan today was to just spend 30 minutes just to brush through the other outstanding concepts so that we can solve questions. But as it is now, with my explanation, it's like I'm taking too much of our time. But again, it's good for you to understand. I can't just rush. Okay, let's move on. Let's move on. So, where cash flow will remain constant to perpetuity. Let me remove this. Will remain constant to perpetuity. Okay. So what we are saying is that after the initial period, the cash flow will not grow at all. The cash flow will remain the same for the foreseeable future. So in this circumstance, the PV to perpetuity, all right, the present value to perpetuity will be calculated as the free cash flow of the base year, all right? Free cash flow of the base year divided by the cost of capital divided by WACC, okay, divided by WACC multiplied by discount factor of the base year. All right, I will explain the letters later on. So this is the formula you are going to use. If in the question you are told that the free cash flow will remain constant to perpetuity, there is no growth. So because there is no growth, then you need to estimate the present value to perpetuity, to infinity. To do this, it will be free cash flow of the base year over the WACC of the combined businesses, then multiplied by discount factor of the base year. Now, number B, where free cash flow, number B, let me shift a little bit, where cash flow, that is free cash flow, will grow to perpetuity. Perpetuity. Okay, so if in the question you are told that the free cash flow will grow at a steady rate to infinity, then in this case, your formula will change slightly. You need to incorporate growth rate. Therefore, the PV to infinity will be computed as free cash flow of the base year, free cash flow of the base year multiplied by 1 plus the growth rate. 1 plus the growth rate divided by the WACC of the combined businesses minus the growth rate multiplied by discount factor of the base year. All right. So that's what you need to do. This is how to calculate the present value to infinity. This is how to calculate the present value to infinity. Notes. Lest I forget. Notes. FCFB is called free cash flow of the base year. All right. G on DF BY equal to discount factor of the base year. Then G is the growth rate. All right. So that is that. That is that. Okay. Now we stop at step 4. Then step 5. You then calculate total market value. Step 5. We calculate total market value. Total market value is the market value of the initial period plus the market value to infinity. So total market value, step 5, calculate total present value, that is market value. So this should be calculated as the PV of the initial period. Whatever it is, put it there. Then you had PV after the initial period or terminal value. Let me write it out. PV, what did I call it? Number 4. PV of to infinity, okay? PV to infinity. All right. So you add the two together. That will give you the total. This is total present value. That is total market value. All right. So this is how to value a business. Whatever you have as your total value, note total market value, that is total present value, represents corporate value. Represents corporate or enterprise value. Okay. So if you are now asked to determine equity value, then equity value will be equal to corporate value minus debt value. That will give you equity value. So these are the things you need to do as far as the first scenario is concerned. I repeat, in the first scenario, business and financial risk will change. Business and financial risk will change. As a result of that, the procedures to carry out is that first thing first, you need to calculate free cash flow to the firm. That's step 1. Step 2, you calculate weighted average cost of capital of the combined businesses. Then step 3, you calculate the present value for the initial period. All right, the initial period is just like the period of the transaction. Okay, it could be for 3 years, 4 years, 5 years, whatever the period to be given to you. Then step 4, you calculate the PV after the initial period. That is, you calculate terminal value to infinity. Then step 5, you calculate total present value. Total present value is the same thing as total market value, which is the sum of the PV of the initial period and then the PV of the PV to infinity. All right, you add the two together, it will give you the total market value. The total market value represents the corporate value, which I said is also known as enterprise value. Okay, it's also known as enterprise value. So in case examiner is now asking you to determine equity value or the value attributable to the owners of the business, then in this case, equity value will be equal to corporate value minus debt value. So this is what you need to do. Let's move to scenario 2. Let me know if you have any question for me before I move. All right, scenario 2. Now, under scenario two will occur. Let me put it down. This occurs where business risk will not change. Business risk will not change, but financial risk will change. Financial risk or debt equity proportion or debt equity ratio will change as a result of the business combination. When this happens, under this circumstance, under this circumstance, the free cash flow, should be discounted or under this circumstance, adjusted present value, let me write it. The APV, adjusted present value, should be used for the valuation. So some of you that are running away from APV, here you have it again. You can't run away from APV. God help you if on that day the scenario is based on APV. Yes, and you have been running away from APV. So yes, APV should be used for the valuation. And then, excuse me, you know all the method are supposed to carry out using APV. Aha. So the first thing you are going to do, excuse me, let me just quickly give you the procedure, even though we have done this in the past. Steps. Step one, you calculate free cash flow. Calculate free cash flow. Then step two. Now, you know when you are calculating APV, we said that when calculating adjusted present value, there are 3 steps or 4 steps. In this case, it will be just 3 steps. Step one is to calculate base case NPV. Step two, you calculate present value of financing effect cash flow. Then step three, you calculate adjusted present value. It's the same thing you are going to do here. So I will then come here, calculate base case NPV, right? Then step two, you determine PV of financing effects, cash flow. Then step three, you estimate adjusted present value. These are the 3 procedures you are supposed to carry out, right? Of course, you know that under each of them, there are things to be done. There are other procedures that you're supposed to carry out. So calculate the base case NPV, okay? So calculate base case NPV. So we are doing revision now, right? Aisha and Co, everyone, we are doing revision. You know, we have done base case, we have done APV before, so we are doing revision. So to calculate base case NPV, step one, is to calculate free cash flow. All right, we calculate free cash flow. Then step 2, you calculate cost of equity on gear. Determine cost of equity on geared. All right. How do you do this? We said there are 3 different ways in which you can calculate cost of equity on geared, depending on the information of proxy given. So if in the question, if you are given, all right, where beta is given, if you are given beta, right, then you are going to carry out 3 steps. Step 1 is to identify the beta. Okay, you identify the beta. Then step 2, you ungear the beta. You ungear the beta if geared. Then step 3, you calculate capping. Calculate cost of equity on geared using capping. Okay, so these are the 3 procedures that you are supposed to carry out where beta is given when you are calculating your cost of equity on gear. Then also, number B, if in the question you are given cost of equity, where cost of equity is given, so if you are given cost of equity, you are supposed to use Miller and Modigliani formula to calculate your cost of equity on gear. So using Milan and Modigliani, cost of equity of a gear is calculated as cost of equity on gear plus, open a bracket, cost of equity on gear minus cost of debt, all of this multiplied by debt value into 1 minus tax over equity value. So this is the Miller and Modigliani formula that you are supposed to use to calculate cost of equity on gear. Again, this cost of equity of a gear will be given to you. What you are looking for is the cost of equity on gear, which you are going to use as the subject uh, uh, as the unknown. In this case, is the unknown that you are looking for. Every other figures will be given to you. So that is basically that. Then the third one is if you are given the WACC, where WACC is given. If you are given WACC, then you need to calculate WACC of on gear. Okay? So if you are given WACC of a gear, it will be calculated as WACC of on gear multiplied by 1 minus debt value multiplied by tax rates over equity plus debt. Okay, so this one and that one are together. All right, so this is the formula that I've given you in the past under APV. Note, the WACC of on gear is the same thing as cost of equity on gear. All right, so these are the 3 different ways in which you can calculate your cost of equity on gear. So after you have done this, you can then proceed to step 3 by calculating the market value, by calculating the present value. So step 3, calculate the present value, which is the same thing, like I said, as the market value. So that is for the initial period, calculate the present value for the initial period. For the initial period, then you then calculate present value after the initial period. Step 4, calculate PV Or just say calculate terminal value after the initial period. After the initial period. So then step 5, you estimate or you estimate the base case NPV. Base case NPV is the total market value. Base case NPV equal to the total present value minus purchase consideration. The purchase consideration is just like initial outlay, but the purchase consideration is the amount one of the parties will pay to the other for the acquisition or for the merger. Purchase consideration. Okay, so that will give you the base case NPV. We then move to calculating the PV of financing effects. Yes, somebody is sending message. Charity, it's supposed to be step 4. Oh, okay. You step 4. It's not step 4. We are still doing step 1, charity. It's not step 4. So I'm explaining base case NPV. Yes. Charity, you are raising hand. Talk to me. Quickly, please.
Don't worry, sir.
Okay. All right. So I will then move to step 2 of APV, which is to calculate PV of financing effects. Okay. Step 2 is to calculate PV of financing effect cash flow. You already know this. Depending on the information you are given in the question, to get the PV of financing effects, let me make this one to be Roman figure 2. Let me make it Roman figure since I'm using a, okay. Let me make it a Roman figure. All right. Then uh, in step 2, we calculate PV of financing effects. Calculating PV of financing effects. Again, you know this. I will just show you the component of financing effects. Under this, depending on the information you have in the question, so you need to calculate PV of issue cost. You know, I took my time to explain to you adjusted present value. What is issue cost? How do you what are the examples of issue cost? How do you estimate PV of issue cost? All of this we have done it in the past, step by step, including the PV of net subsidy. All right, what you need to do under each of them, we have done it in the past. So subsidy, this is a minus, this is a plus. Then you consider PV of tax saved on interest. So under business valuation, it is not compulsory that you are going to have the 3 of them. It may well be that you may have only one, whichever one that you have. Whether you are given the 3 of them, issue cost, subsidized loan, tax saved on interest, whatever the case may be, just go ahead and compute PV of financing effects. All right, so like I said, all the procedures for calculating each of them, we have done it in the past. Just refer to your notes. Then Step 3, which is the last step, is to calculate adjusted present value. So calculating adjusted present value. The adjusted present value will represent the base case NPV. Base case NPV plus minus PV of financing effects. Cash flow. So it could be positive or negative. Your APV could be positive or negative. This is your adjusted present value. So your APV notes adjusted present value equal to corporate value. Adjusted present value is equal to corporate value. Therefore, equity value will be equal to APV minus debt value, or corporate value minus debt value. Okay, so these are the procedures that are supposed to carry out anytime you want to value a business using adjusted present value. That is, where business risk will not change, but financial risk will change as a result of the business combination. So these are the procedures under the scenario 2. The last scenario, this is very short. The last scenario is short. This will occur where business and financial risk will not change. Okay? Scenario 3. Scenario 3. In this case, business risk and financial risk will remain constant, will not change. All right. So that is scenario 3. This arises, or this is a situation whereby business risk and financial risk will not change. Will not change as a result of the business combination. When this happens, or in this circumstance, the free cash flow should be discounted using the existing WACC, using the WACC of the combined companies, using the current WACC, let me put it that way, using the current WACC of the combined businesses. Okay, so that's what you need to do. So the same way you normally calculate WACC, weighted average cost of capital, that's what you are going to do. Just calculate the WACC after the business combination, and you use it to discount the free cash flow. That's what you need to do. This is the simplest. The last time I can tested this scenario 3 was 2019. And it was a kind of question that, okay, you are joining, you are enjoying, but it takes time. But in any case, if possible, we may get there. All right, so these are the 3 different scenarios under business combination when you want to value merger and acquisition transaction. These are the 3 different scenarios that may arise. Okay, and then so These are the relevant explanation. Under each scenario, your present value or market value must be in two stages, the initial period and then the terminal value to infinity. So you have to calculate your present value in those two stages. Otherwise, you may not get the right answer if you do for only one and you forget or you ignore the other side. So you can't get your full answer. All right. So yes, now so talk to me. Yes, no, so
Okay, sir. Good evening, sir.
good evening.
Sir, please, I want to take you back. When you are giving us the format for free cash flow,
Yes,
you mentioned of if the examiner give us maybe 2 financial years
yes.
for us to find our changes in working capital, and you say there is a format to calculate the working capital, and you did not give us.
I
Is
didn't say there's a format. I said there's a formula of all. Well, you can say there's a format. When we get, don't worry. When we have illustration, we say it.
okay, okay,
Yeah.
and also
You, yeah.
purchase additional assets.
Pardon?
I said also when there is an additional asset purchase within the year.
Yeah. No worries. See, this is what I'm trying to say. When you want to calculate changes in working capital, when you are given two periods, already that working capital is, you can mute. Working capital is current assets minus current liability. In a question, examiner may not tell you, the examiner will not mention working capital. But once you can see in a question, when you are given two periods, all right, you are given statement of financial position, balance sheet for two different periods. So that means examiner wants you to watch out for movement in working capital. So, and you know that working capital is current asset minus current liability. So in the question, when you now want to determine changes in working capital, let's say, for example, you are given, let me put it this way. Okay. No, so you are forcing me to give you this. Well, I have no choice. Changes in working capital. Whenever you want to determine changes in working capital, so just like a format, this is particularly possible when you are given two periods. Let's say, for example, we are given 2023 balance sheet. We're also given a balance sheet for 2024. Then you now want to determine the change between the two, what has changed between the 2 years. Let's say, for example, in the question, you are given inventory. Remember, we said working capital is current asset minus current liability. I will go to under current assets. What are the components of current asset as given to me in the question? Let's say you have inventories. Inventory in the first year. Let's say, let's use figure. Let's say inventory in the first year is 1,000. And then in 2024, inventory has increased to 1,200. Between the 2 years, what has changed? 200 is the change. What kind of change? Is it an increase or a decrease? In 2023, we spent 1,000 naira to purchase inventory. In 2024, our cost has increased to 1,200. That means this is an increase in working capital. We put it in brackets. Let's say, for example, we also have receivables. Let's say receivables in 2023 was 1,500 naira. In 2024, receivable is now 1,100. Okay, so before our our debtors has grown to 1.5, more cash has gone out in 2023, but in 2024, our cash, the receivable has reduced to 1,100. It means that some of our debtors, they have paid part of the money owing to us. So the difference of 400 is positive. More cash flow has come in. Let's say, for example, these are the two elements that we have for simplicity. These are the two elements that we have. So all I need to do now is to now determine changes in the working capital. I'm less concerned for each of the year. I'm looking for the total. The total change is what I need. Therefore, I will then come here to minus 200 plus 400. So this will give us 200. So this is increase in working capital. Sorry, this is a decrease in working capital. This represents a decrease in working capital. This is a plus. This is how you are going to determine your changes in working capital. Please, when you are determining changes in working capital, you don't consider anything that has to do with short-term financing. Short-term financing is not part of operating activity. It is part of financing activity. That's one. Then two, when you are determining your working capital, you don't consider cash or bank balance because it's not something if you have cash, it's not something that you are looking for. You already have it. So it's not something that you want to, you don't include. The bottom line is that you don't include cash and bank balance in your work. When you are determining working capital, you have to ignore it. All right. So that is as per that. Then the next item would then be as requested by Chinonzo is that I need to, as I said, I mentioned the format for determining the purchase of additional non-current assets. I can either use formula to do this or I use a T format, okay? Changes in non-current asset. Let me call it changes in non-current assets. That is, I want to know if additional non-current asset has been bought. Examiner may not tell you that additional non-current asset or the company has incurred capital expenditure. It is implied in the once you are given 2 periods balance sheet, you have to watch out for that movement. So if I want to do this, I can either use the T format or I use a formula to derive my answer. So if I want to use the T format, remember, non-current assets is a debit balance. So here will be balance brought forward. Here will be balance carried down. Now, during the year, there will be profit and loss. There will be depreciation. So if there's any depreciation, so profit and loss, in the P&L, we have depreciation of assets. So the balance carried down will be given to us. Balance carried down will be given to us. Put it here. The depreciation, of course, you may be the one that will determine it or it will be given to you. Then you add the two of them together. All right. Now, to now get the additional non-current assets, to now get the addition, non-current assets, it will be this total minus the balance brought forward. So that will give you the additional non-current asset purchased. Okay, this is the T format for determining if additional non-current assets has been purchased. If I don't want to use the T format, I can use formula. All right. So using formula, addition will be equal to closing balance plus depreciation minus opening balance minus opening non-current assets. Opening non-current asset. Let me call it closing non-current assets plus depreciation, then minus opening non-current asset. That will give me additional non-current asset purchase. Chinoso, I believe you are okay now. Chinoso, have I met your demands?
Yes, sir. Thank you very much.
You are welcome. Yes, Aisha, talk to me.
Good evening, sir.
Aisha. Yeah, good evening.
Yeah, the last, I think, change in working capital.
Yes.
If you can, yes, where you said decrease in working capital. I don't know. Is it a decrease or increase since it's positive? The receivables that came in cover over. No, I don't know.
It's a
I'm kind of
decrease.
confused why you said
No,
decrease.
this is a decrease in your receivable. Before, customers were owing you 1,500 naira. In
Mm.
2024, they are now owing you 1,100. That means they have paid part of the owings to you. So they have paid
Yes,
part
sir.
of. So what they paid was 400. Once customer paid, you are going to receive cash, Abi.
Cash. Yes.
So you receive 400 cash
Yes.
inflow. But in
Yes.
the inventory, you have
Yes.
paid more inventory in 2024 by 200. So your inventory has
Yes.
increased by 200.
Yes.
So your receivable has reduced by 400. That means you have more cash inflow. You have more cash inflow than the cash outflow.
Yes.
400 is more than 200. That's why you have the decrease of working capital by 200. So positive, this 200 is positive. Okay, the focus is on the change. It's on the last column. It's on the change. You receive
Mm-hmm.
between the 2 years, between 2023 and 2024, you receive 400 naira. Within the
Mm.
same period, you paid out of the 400 naira cash inflow that you received, you paid out 200. That means you have a plus of
Okay.
200. Share you get?
Mm. Yes.
Uh-huh.
I understand now. Mm.
It's okay.
Thank you, sir.
You are welcome. You can put down your hand. So at this point, what else do I need to tell you now? I think we have covered almost everything. If there's any other one I remember, so I will let you know. But for now, we have covered the ground, enough ground, so we can have illustration to this effect. So my intention today was to solve 2 or 3 illustrations, but time will not permit us. So let's have illustration. Let me stop sharing this and share the material and see which one we can solve within the next 45 minutes. Let's see. So you can go to your material and read more, even though some of those things I explained are not, some of them, you can't find it. All right. Now, one thing you need to know, examiner can ask you that you may be asked to determine additional equity value created. In fact, that's additional information. Let me stop sharing this. I've said this, if my memory serves me here well, I will tell you more. So let me add to that. Examiner can ask you to advise whether the company should go ahead with the acquisition or with the merger. All right. The company should go ahead with the acquisition or with the merger if it will result in additional equity value being created. Okay, let me put it down. Examiner can ask you to advise. Under this advice, you may be asked to advise whether the company should go ahead with the acquisition or merger. The acquisition or merger should be considered or should be considered if it will result in additional equity value being created. All right. You know, the essence of the primary purpose of any business organization, of any profit-making company, is to maximize the shareholders' equity value. So, if the merger and acquisition will result in additional equity value being created, it means that the acquisition should be considered. It means that the acquisition or the merger should be considered. But if not, then it should not be considered. How will you know that additional equity value will be created if the post-acquisition market value is greater than the pre-acquisition market value? It means the additional equity value will be created. Let me put it down for you. Additional equity value will be created if the post-merger equity value is the equity value after the business combination. If the post-merger equity value is greater than the pre-merger, either pre-merger or pre-acquisition equity value. The pre-merger equity value is the market value before the merger. All right. The pre-acquisition market value or equity value is the equity value before the merger. Okay, so that's that. Finally, in my notes, examiner can ask you to determine the maximum price to pay. All right, maximum price to pay. The maximum price to pay will represent the difference. Okay, let me put it down. This represents the difference between the post-merger or post-acquisition post-merger market value and pre-merger market value. The pre-merger market value of the combined businesses or of the predator. In the event of acquisition, examiner may want to know what is the maximum price to pay. You know, when you want to acquire a company, it is the acquiring company that will make the initiative. It's the one that will initiate the transaction. For example, now in football, in the football world, I'm a, I'm a gunner, right? If Arsenal wants to purchase, if Arsenal is interested in a player, it's Arsenal that will make a move that, okay, I want to sign this player, right? So that means Arsenal is the predator, is the one that wants to acquire that player. So to now determine the maximum price that Arsenal will pay, it will be the difference between, after I've acquired the player, what is the market value of that player that I want to acquire plus my own market value. That is the combined, that is the market value, that is the post acquisition market value. Then minus, okay, minus the market, minus my own market value before I acquired it. So the difference between the two will give me the maximum price that I'm supposed to pay. All right, so maximum price to pay is the difference between the post-merger market value and the pre-merger value of the predator. So it could be for the predator, it could be for the combined business, depending on the scenario in the question. All right. So the predator is the company that make the first move. All right. Even in the merger, the first company that make that move of merging with another company will represent the predator. All right. So these are the things that examiner can ask you. So in this case, what that means is that you need to first of all calculate the post-merger value. The post-merger value is the market value after the two businesses have merged together. Then the pre-merger is the market value before the two businesses come together. The value of each of the businesses before the merger. All right, that's the pre-merger market value. So the market value after they've now merged together is the post-merger market value. Okay, so I just say I should mention that as well, because these are the things you are going to be seeing in a question. These are the things you will see in a question, and you must know what to do under each scenario. All right. Like I explained to you last week, business valuation is the most frequently tested topic in ICANN. There's no diet. There's no single diet that you will not have one question under valuation. If it doesn't come as a compulsory, it will come as section B, and then watch out for that. Let's move on. Let's have illustration. We can't do more than one illustration tonight. Yeah. Okay. Now, because currently in Nigeria, banking industry there's a regulatory change going on in the banking industry in Nigeria, whereby the Apex Bank, the CBN, has instructed that each bank in Nigeria or every bank in Nigeria should recapitalize based on a specific threshold. So I won't be surprised if ICANN is testing something relating to that. If not this diet, it may be next diet, because 2026 will be the deadline. The deadline will expire, I think February, is that February? Between February and I can't remember the exact date. In 2026, first quarter 2026, it will expire. So according to the CBN, I think about 14 banks now have met up with the have met the threshold. So others are still putting up to ensure that they meet up with the deadline. But again, I think that's why it is important. We have to be consistent. You have to be you should be nosy to follow the trend, what is happening in the economy or within the market, so that you know in case, if any, especially when you are writing ICANN, so you never can tell where the question will come out. All right. So let's have this illustration number one. I think this one has to do with the dividend yield basis. All right. Should I even solve this one? Okay, let's solve illustration number 2. Let's solve illustration number 2. Starting from the way I explained the methods: asset-based approach, income-based approach, then discounted cash flow based. So let's start from asset-based approach. So this asset-based approach is also very common in ICANN, even though it's very straightforward, but it's also very common. All right. Let's have somebody should help us to read this. Who is helping us quickly? Yes. Who is helping us? Yes, I know the person that will read for us. Uju, hold on first. Uju, hold on first. Okay. Charity. Charity, you are my partner tonight. You have to read. Where is Charity? Oh, she has disappeared. See now, Charity is not on. When she comes back now, you'll be asking me a question. She only asks me a question. When I have to read, she will not raise her hand to read. You see now, she has disappeared. When she now comes back, will be asking me questions. Oh yeah, Uju, go ahead. Thank you.
The entire share capital of Wazobia Limited, an unlisted company, is held by 3 directors of the company: Chief Oyemesi, Balogun, and Akogu. They have decided to sell their shares in order to complete a divestment proposal agreed with management, and as such, wish to know the likely value of the shares before approaching prospective buyers. Should they fail to get buyers for the share, the company will go into liquidation. The following information is provided in respect of the company. A. Statement of financial position of Wazobia Limited as at 31st December 2011. Non-current assets.
B.
B. Extracts from the published statement of profit or loss and other comprehensive income for the last 3 years are: it was discovered that inventories were overvalued at the end of 2008 by 600,000. The directors have increased their remuneration in order to reduce the company's tax liability. A realistic charge for services rendered would be 1,875,000 naira. The equipment is old and it is in need of replacement. The annual depreciation based on current replacement cost is in the region of 3 million naira. C. Each of the directors expressed different opinions on the valuation method to be adopted to Chief Oyemesi. It is most appropriate to value the shares on the basis of price-earnings ratio. For this purpose, he argues that earnings should be defined as the average reported profit for the last 3 years, after making proper charges for depreciation and directors' remuneration, and correcting errors made on inventories in 2008. In his own opinion, Balogun recommends breakup basis using liquidation value as provided by experts. Akongo, on the other hand, believes that dividend yield basis used with available data obtained from two similar but listed companies where he is a shareholder. D. The relevant data of the two listed companies engage in similar line of business as Wazobia Limited are as follows. E. Figures obtained from experts of items appearing in the statement of financial position of Wazobia Limited as of 31st December 2011 are stated below. You are required to A. Compute the value of the entire share capital of Wazobia Limited using price earning basis, with earnings computed on the basis proposed by Chief Oyemesi. 2. Liquidation breakup basis. 3. Replacement value basis. 4. Dividend yield basis. Note: assume you are making the valuation as at 31st December 2011. Ignore taxation and liquidation costs, showing all workings. B. Identify any two limitations associated with each of the methods above.
Yeah, thank you very much. This question has been tested twice by ICANN, and is a good one for explaining how to carry out valuation using asset-based approach, right? So if that is the case, I will stop sharing this and then move to the working note. In the A requirements, you have to determine the value of Wazobia Limited using price earning basis, 2, liquidation basis, 3, replacement value basis, and then dividend yield basis. So this question is mainly about asset-based approach and then income-based approach. So if that is the case, let me stop sharing and then move to the working note. Yes, this is solution to illustration number 2. Solution to illustration 2. That's page What page is that? Page 82, page 81. 81 to 82. All right. So we want to value the business using price earning ratio. The name of the company is Wazobia Limited. All right. So requirement A1. Requirement A1. We want to determine value of Wazobia. Determining value of Wazobia using price earning ratio. Using price earning ratio. You will recall when I was explaining the concept last time, I mentioned that using price earning ratio, the value of a business is PE ratio multiplied by earnings. All right, PE ratio multiplied by earnings, and that the PE ratio is mostly suitable for a company that has a profitable history. Any company that have history of profit making, then such company can use price earning ratio for the purpose of valuation. And I also mentioned that when you value a business using price earning ratio, when you are valuing a limited liability company using price earning ratio, you have to borrow the PE ratio of a uh, comparable companies that have similar business risk, that is operating in the same industry with that of a limited liability company. In this question, Wazobia Limited is a limited liability company, which means that Wazobia does not have PE ratio because Wazobia Limited is not quoted on stock exchange. Therefore, you need to look for a company that is quoted, that is listed on stock exchange, whereby you borrow the PE ratio. And then thirdly, I mentioned to you that when you value an unquoted company, when you are valuing a limited liability company using PE ratio, you have to adjust the PE ratio of a quoted company downwardly between the ratio of 10 and 50, depending on the perceived risk associated with a limited liability company. So Wasobia is a limited liability company, which means the company does not have PE ratio. And then examiner has told us in the question that we have been given a P/E ratio of a quoted company. We are given a P/E ratio of for company 1 to be 5.4. We are also given P/E ratio of company 2 to be 6.6. When you add the two of them together, that's 12. The P/E ratio is 12 of the combined businesses. All right. So if that is the case, you then find, because you have added two numbers together, you find the average. So 12 divided by 2 will give us 6. Now, that 6P, the average P ratio of 6, you cannot use it because the P ratio is for quoted company. Wazobia is not quoted. Therefore, we need to adjust whether we want to use 10, 15, 20, 18, 12, 25, 30, or 50%, whether we want to adjust the P ratio by whatever the percentage, depending on the perceived risk. So that's what you are going to do to get the adjusted P ratio for a limited liability company. Now, you keep it on one side. The second part, you recall last week when I was telling you this, on the day of your exam, if examiner wants you to calculate the value, when you have to determine the value of the business using the P ratio, the P ratio is not the problem. The PE ratio is not the problem. The problem is the earnings. The earnings that you are going to use on that day is not going to be a straightforward kind of earnings. You can't just go to the question. You are going to see the profit after tax in the question, but not that one that you are going to use. The examiner will, will tell you, because companies carry out different kinds of uh, subjective accounting, some ascertain accounting, just to achieve a particular financial goal. So as a result of that, examiner will tell you different scenarios, so you need to walk back. You need to make an adjustment to your earnings for you to have a revised or adjusted earnings. So once you have the adjusted earnings, then you can multiply with the price earning ratio. So that is basically that. Now, in this question, now that I know the formula that I want to use, value of a business is price earning ratio multiplied by earnings. So in this case, I need to calculate what is the price earning ratio. All right. So according to the question, Wazobia Limited is like as the name implied, it's a limited liability company, which means that the company does not have a PE ratio. I will then go to the question, am I given comparable company that is listed on stock exchange? Yes. Examiner has told us that there are two companies listed on the stock exchange. We are told that we have company one and company two. Company one has a PE ratio of 5.4, then company two has a PE ratio of 6.6. Okay, so here is 5.4 plus 6.6. Then you divide it by 2. Because you added two numbers, you have to find average. So here is equal to 12 times divided by 2, which is equal to 6 times. You know, P ratio measures is a number of times, not in naira. It's not so that you don't go and put in 6 naira. So it's measures in times. You want to know how many times the share price cover earnings per share. All right. So then I would then say adjusted, I would just say adjusted PE ratio, adjusted PE ratio equal to 6. Now, this is what I was telling you earlier today. The percentage that you are going to adjust will differ among students. I may decide to adjust by 15%. Another student can adjust by 12%, 20%, 18%, 25%, or even 30%, depending on the perceived risk associated with Wazobia, which means that all the students cannot have the same answer at the end of the day, except that if examiner has told you that you should adjust for the P ratio of the comparable company by a specific percentage. So in that case, examiner wants everybody to have a uniform answer. But I have never seen any question where examiner says that. So, but in any case, this is what we are going to do. In my own case, I can assume 15%. I want to adjust for 15%. So in this case, if the risk associated with Wazobia Limited is 15%, that means I'm supposed to account for 85% of the PE ratio. So here will then be equal to 85%. That is 100% minus 15%. So that 15% is for the risk. All right. So I will then do 85% of 6. So 6 multiplied by 0.85 equal to 5.1. So that means I'm going to use P ratio of 5.1 to calculate the value. Now, we can then say, note, it is not sufficient to do this. Whatever you remember, I also told you last week, you have to state your assumption. How do you arrive at your adjusted PE ratio? You have to let the examiner know your position, the basis of your adjustment. So I would then say, note, Wazobia Limited does not have a PE ratio. Therefore, the average PE ratio of the comparable quoted companies. Oh, comparable. I wanted to write comparable of the comparable quoted companies of 6 Okay, the average P ratio of 6. Let me rewrite this so that to be clearer. Therefore, the average P ratio of 6 of the comparable quoted companies has been adjusted to has been adjusted downwardly by 15% to account for the risk associated with or for the risk inherent in Wazobia Limited. So once the examiner sees my assumption, then they understand what I've done. So, but if you just assume without stating your assumption, how would the examiner, where did you arrive at? How did you see 5.1 in the first place? So that's why you have to state your assumption. Let the examiner know your position and the reason why you do or why you do it the way you have done it. Okay, so that is, now we have the P ratio. We have the other side, which is earnings. So let's determine our earnings. Ordinarily, we are supposed to go to the question and pick earnings. In this question, you are given earnings for the profit. Profit after tax is the same thing as earnings. So profit for the year 2009 was 3250, 3600 for 2010, and then 4175 for 2011. Ordinarily, we are supposed to add up the three periods earnings. Then you divide it by 3. But in this situation, we cannot do that because examiner has told us in the question that inventory were overvalued. Director's remuneration was also overcharged. Then the depreciation was undercharged. So all of this, you need to make an adjustment. You have done IS 8. Okay, you have done IS 8. So you know what retrospective and prospective adjustment is all about. All right, so let's move on. Now we need to determine a revised earnings. So we need to calculate revised earnings. So to do this for the 3 periods, which is 2009, 2010, let me push it to the front. Total will be here. Then 2011, 2010, then 2009. All right. So I will then go to the question. First thing first, profit for the year. So for 2009, profit for 2009 was 3250. 3250, here is 3250, 3600 for 2010, then 2011 4175. We add it up. This will give us 3250 plus 3600 plus 4175.
1125.
11, you said 11
025.
and 25, 11,025. So ordinarily, I'm supposed to divide that 11,025. I'm supposed to divide it by 3 years. So that will give me average profit for the year. But because in the question, There are some adjustments we need to make. Then we go back to the question and read the scenario one after the other. After the table, after the first, second table, where you have the B part, you are told that it was discovered that inventories were overvalued at the end of 2008 by 600,000. You know, when you overvalue inventory, that means your profit will drop. You know, in the statement of in the income statement of a company, the top line item is your revenue. So from your revenue, you deduct the direct cost. Inside your direct cost is where you have your inventory, your direct material, all those things. Your finished, all those stuff are embedded in the cost of goods sold or your direct cost or cost of sales. All right. So because you have overvalued your inventory, that means your cost of inventory has gone up. If your cost has gone up, it means that your gross profit will be lower, will reduce. If your gross profit reduce, certainly your tax they are going to pay will also reduce. So because you have overvalued in 2008, end of 2008, you overvalue by 600. Therefore, in 2009, because you have to make a prospective adjustment. So in 2009, you have to account for the difference. You have to return the difference that you have overvalued, which is, of course, is 600,000. Therefore, I will then come here. Inventory overvalued. Excess of inventory. Excess, or let me just put it this way. Inventories. I have to, it's almost done. Let me a little bit faster. Inventories overvalued, which is 600. It will only affect 2009. It won't affect 2010. So here is 600. You had it back. Then after that, you are also told that the directors have increased their remuneration in order to reduce the company's tax liability. You know, after gross profits, the next thing you are going to do is to less operating costs or operating expenses. Within the operating expenses, you have your director fee or management fee, whatever. So everything is embedded in the operating expenses. So once your operating expenses increases, that means your profit before interest and tax will also reduce. So we reduce. So how do you make adjustment? Examiner now told you that a realistic charge for services rendered by the directors will be in the region of 1,875,000. Instead of the company to charge directors remuneration of 1,875,000, they end up charging 2.5 for 2009, 2.9 for 2010, and then 3 million for 2011. So the difference, the excess that you have charged, you need to return it. So I can say excess on director's remuneration. Director's remuneration plus a space. Let me do it this way. Let me do this as an example. Director's remo. So come here. So in the first year, the company charged in 2009, director's remuneration charge was 2.5 million instead of 1875. So I will say 2,500 minus 1875. Oh, I need space. Let me reduce this. Excess on director's remuneration. Let me write that, make it bigger a little bit. Remuneration. So here is 2,500 minus 1875. That's for the first one. So what's the difference between the two?
625.
Pardon, 625. 625. Then in 2010, 2.9 million, 2,900 minus 1875. What do you have?
1025.
1,025. Here is 1,025. In 2011, director's remuneration charge was 3,000. So 3,000 minus 1875.
1,125.
1,125. We then add up the three. So this would be
2,007.
2,007 what?
775.
775. Okay. I believe that is correct. 1,150. Yeah, correct. Then we move back to the question again. You also told that the equipment is old and is in need of replacement. The annual depreciation based on the current replacement cost is in the region of 3 million naira. The depreciation, the company is supposed to charge a depreciation of 3 million naira, but they end up charging depreciation of 2,250,000. That means they undercharge depreciation. Once you undercharge your depreciation, your operating expenses will be lower. Okay, if you undercharge your depreciation, your operating expenses will be low. So if that happens, then that means your profit will go up. So you need to correct that. Depreciation or undercharged depreciation. Undercharged depreciation, which is if they were supposed to charge 3,000, they end up charging 2,250. So the difference is 750. That's a cash outflow. So in the subsequent years, you need to return it. 750, 750. That will give us 2,250. What else? Let's go back there and check. So that's it. So at this point, we then find I need the total. I'm less concerned with the other years. My focus is on the total. So what's the total? What's the total value there? On your own notes, you can do for
12,150.
12,150. All right. So in your own notes, you can do total for the other years. This is the total earnings. This total earnings is for the 3 years. So I need to find average earnings per year. So average earnings will then be equal to the total of 12,150 divided by 3 years. So what do you have?
4,050 naira.
So here will be 4,050 naira. Remember, our figures are in thousands. Therefore, now that we have the revised earning, we can then go back to come to do the valuation. Okay, no value. We said value is equal to price earning ratio multiplied by earnings. Therefore, using the price earning ratio, value is equal to price earning ratio of 5.1 multiplied by adjusted earnings of 4,050,000. So the value of Wazobia would then be equal to 4,050,000 multiplied by 5.1. That's 20,665,000. 20,655,000 is the value of Wazobia. So using price earning ratio, the value of Wazobia Limited is 20,655,000. So that answers number one. We are moving to number two requirements. Number A2. In the A2, we are to use liquidation or breakup basis. We are going to merge 2 and 3 together because 2 and 3, they are asset-based approach, method of valuation. Therefore, I'm going to merge 2 and 3 together. So valuation using liquidation, using breakup, and is it replacement or realizable? Let me check. And the replacement basis, replacement value, basis. So like I said, we are going to use only one table to achieve this. How do you arrive at 5.1? No, so did you leave the class? Why are you asking me how I arrive at 5.1? You were there when I was calculating and when I also state my assumption. You're asking me, well, how did I arrive at 5.1? No, so did you leave the class?
Yes, sir.
So you left the class, so I just coming, you want to drive me back again. If you are in the class physically, will you leave the class? So let me finish. We are running, it's already time for closing. So when I finish, then I will come back to your question. But for now, let's focus so that we can. So we have now, because we have the same uh, the breakup basis and replacement value basis, they are under the same category of valuation, which is asset-based approach. So I can use only one table to achieve the same results. So for the 2 and 3, that's what I'm merging 2 and 3 together. So I will then come here, breakup basis, then replacement value basis. So what am I supposed to do? Remember, we said that the value of a business using asset-based approach represent the net asset. Therefore, I want to calculate net assets using breakup basis and then replacement value basis. I will then go to the balance sheet as given to us. I need to go to the balance sheet as given to us in the question. So according to the question, under the balance sheets, the first item there is freehold property. The first non-current asset. Remember, net assets is the difference between tangible non-current assets, tangible assets, and then total liability. So in this question, and I told you if you are given when you are given intangible asset like goodwill, copyright, patent rights, all those ones, all the intangible assets should not be included when you are valuing a business using asset-based approach, except they have a market value. So in this question, we don't have any of those intangible assets. So there's no need for us to stress ourselves. So the first non-current asset given in the question is the freehold property, which is 6,500. Now, I need to ask myself, under the breakup basis, are we given freehold property? Let's check. Yes, we have freehold property under breakup basis to be 15,000. Under replacement is also 15,000. So I will then come here, freehold properties, 15,000. Our figures are in thousands, so 15,000. Then the next one, from the balance sheets. From the balance sheet, the other asset given to us is the equipment. We are given equipment to be 15,600. So under replacements, how much is equipment? 8,650, then 54. So I will then come here, equipment, 8,650, 5,400. Next one, I will go back to the question in the balance sheet. What's the next assets? The next one is current assets. Under current assets, we have inventories. In the book value of the inventory is 6,975. I will then go to the replacement and liquidation value. Am I given inventory? Yes, we are given inventory to be 4,350 and then 8,000. So inventory, there's no need for categorization by saying the no current asset, current asset. Don't need to do that. What did I even call it? 4,350, then 8,000. Here is 4,350, then 8,000. All right. So I'll go back again to the balance sheet as given to us. After inventory, we also have accounts receivable. Accounts receivables, we are given 4,825, but under the replacements, under the replacement and liquidation value, we don't have anything like receivables. Therefore, you are going to repeat what you have in the balance sheet. So, receivables. So we repeat it, and the receivable is 4,000. Is it 4,000? Let me check again. 4,825. 4,825 is the receivable. So here will be 4,825. 4,825. So any asset that you don't have replacement value for, you are going to use your book value. All right. Then we also have, according to the question, we also have cash equivalent, that is bank, which is 650. So cash equivalent 650. 650. So you add up. We are done with all the assets. So you add it up. Wumi, are you listening? Some of you have disappeared. No worries. You now come back briefly. You will be asking me question after when you did not even wait in the class. 15,000 plus 8,650 plus 4,350 plus 4,825 plus 650 equal 33,475. 33,475. A wise student should have gone ahead and give me for replacement value basis, but you will not give me until I ask. Sam,
33875.
thank you. You're a wise student.
875.
33,875. That must be Uju. Is that you?
Mm. Yes, sir.
All right. Thank you. So here will be total assets. Then you now less total liability. In the question, you are given the current liability of, let me see, how much was that? Current liability of 4,150. So that's it. Current liabilities, 4,150. You minus 4,150. The difference between total asset and total liability will give you your net assets. In this question, we only have current liability. Therefore, this will give us the net assets. What's the difference?
29,325.
325 under the breakup basis. Then under the
Replacement.
replacements,
29,725.
725. I will then say the value of Wazobia using of Wazobia Limited using the breakup basis is 29,325,000 naira, and 29,725,000 using the 29,500,000 naira for replacement basis. Let me write that. For replacement value basis. That's that. We have about 5 minutes more. The last one is talking about 1, 2, 3. Talking about dividend yield. We have to use dividend yield. Number 3. Let me see. Yes. Sorry, number 4. Dividend yield basis. Examiner is asking us to use dividend yield basis. And you know that the market value of a company using dividend yield represent the present value of future cash flow discounted at the dividend yield or cost of equity of rate of return on equity. All right. So valuation using dividend yield basis. So like I said, the value of a business using dividend yield represent the present value of future cash flow. The future cash flow is the dividend that the company will pay, then discounted at the dividend yield. Dividend yield is the same thing as cost of equity or rate of return on equity. Therefore, I would then say market value equal to dividend. The formula in the question, you need to go and check if you are given the growth rate. In this question, we don't have anything like growth rate. Therefore, we don't need to stress ourselves. No growth. No growth. So that would then say divided by dividend yield. And I said dividend yield is the same thing as cost of equity. So in this case, the dividend given to us in the question, let's go back there. According to the question, you are given a dividend of 2,250,000. Okay, we have a dividend of 2,250,000, and dividend is constant. You can see the dividend is, if the dividend is changed for each year are different, that means you need to go and calculate growth rate. But again, the dividends are constant. So if that is the case, I would then say dividend is 2,250,000. Let me do it this way. Dividend equal to 2,250,000. Then dividend yield. So we are not given dividend yield for Wazobia, but we are given dividend yield of comparable company. No adjustment is needed in this one. So yes, the dividend yield of the comparable is 9% for company 1, then 11% for company 2. You add it together, then you divide it by 2. So 9% plus 11% divided by 2. Let me write this to make it clearer. Then divided by 2. So this will be 20% divided by 2, which is equal to 10%. So the average dividend yield is 10%. So in this case, market value would then be equal to 2,250,000 divided by 10%. So this will give us 22,500,000. Let me confirm. Let me
Yes.
use 22,500,000, right?
Yes, sir.
Okay, here will be 22,500,000. I would then say the value of Wazobia Limited using dividend yield basis is 22,500,000 naira. So that's it. That's it. In the B part of the question, you are to identify any two limitations associated with each method of valuation. What are the limitations under price earning ratio? One of the limitations is that, of course, price earning ratio can only be used by a profit-making organization. Any company that does not have profitable history cannot use price earning ratio. So that's one limitation for that. Another one is that, of course, when you talk about price earning ratio, yes, the price earning ratio, not all companies can, any company that is not quoted on stock exchange cannot use price earning ratio. In this case, you have to look for a company that has a PE ratio that you can use. So the process could be cumbersome to achieve. Then not only that, the PE ratio does not consider capital structure of a company. All right. So I've given you three. Examiner say two. All right. So the second one is the liquidation basis. What are the limitations under liquidation basis? For liquidation, of course, to determine the liquidation value, we need an expert. You need the opinion of an expert. You need an expert opinion for them to be able to value the assets or in order to determine the breakup values. So this will be an additional cost on the part of the business. All right. Then also, using liquidation value basis, the breakup basis, you don't consider time value of money. You do not consider time value of money. Even P ratio too, you do not consider time value of money. It's part of the limitation. Okay. Now, then for the replacement basis, it's the same thing. You can just say for replacement value basis, you do not consider time value of money, and this does not take into consideration. Uh, yeah. Then number four, the dividend yield. So just for those of you that have the golden book, you can see as many. I gave different disadvantages of using any of the methods. I gave different what's it called? Different limitations. So you can just go through your material because of time. I don't want to delay you beyond the timing I've taken from your it's already past 18. Okay, so that will be the end of today's class. In our next class, by the grace of God, we are going to have minimum of two different illustrations. So that means we have about two more periods to go. We have about two more periods to go. If you cooperate with me in our next class, so if you cooperate with me, we can be able to solve like three. Now, Chinonzo, let me see if you are still around because you might have disappeared. Let me check.
Yes, I'm here, sir.
So you are asking me how did I get 5.1? The 5.1 is the result is the working that we did. And I explained to you that when you are valuing a business using price earning ratio, you are supposed to adjust. You are supposed to adjust for the risk inherent in an unquoted company. All right. So for a limited liability, when valuing a limited liability company, see, I was surprised when you were asking me, how did I get 5.1? So that's what I asked you. Maybe you left the class and come back again and be, it's because it's already there. I stated this assumption here. The Wazobia Limited does not have a P ratio. Therefore, the average P ratio of 6. The P ratio of the two companies, the first company P ratio is 5.4, the second company is 6.6. You add it together, that's 12. You divide it by 2 to get the average of 6. That's the P ratio of 6. So to now account for the risk associated with our Zubia Limited, we adjusted for 15%, which means that the risk associated with Wazobia is 15%. That means we are supposed to account for only 85% of the PE ratio. So 85% of 6 is what gave us the 5.1. And I said that at all time, anytime you make such an adjustment or an assumption, you have to state your assumption. And I said to state your assumption, this is what you are supposed to say. This is what you are supposed to say. It's not compulsory. You have to say the way I have done is we are different people with different capability. Some people are good in report writing. In the way you are going to present your statement may be different. It's not compulsory. You have to do it this way. What I said, Wasobia Limited does not have a P ratio. Therefore, the average P ratio of 6 of the comparable quoted companies has been adjusted downwardly by 15% to account for the risk inherent in Wasobia Limited or associated with Wasobia Limited. So this will tell the examiner how we have arrived at our numbers. So that's end of that. I believe that is clear to you, Chinozo. Or do you want me to go further?
It's okay.
It's all right then. So any other question for me so that we can close the class? Any question? Some of you have disappeared. Adeoshun is still on. Chinozo, Anthony, Augusta, Victor, Sherame, Uju is still around. Wumi is around. Tayo has disappeared. The majority of you have disappeared. No worry, it's okay. All right. So, in the absence of no further question, I want to say thank you to every one of you and for your patience. You waited behind, even though we have outspent our time by 21 minutes. I want to say thank you, everyone, for that privilege. I will see you next time by the grace of God. Good night, everyone.
Good night, sir.
Good night, Uche.
Good night, sir.
Nice, sir.
Yeah, good night, everyone. Chinozo. Yeah, good night.